The most dangerous moment in any financial bubble isn't the crash. It's the moment when doubt disappears. That's when prices are climbing, confidence feels earned, and skepticism starts to sound old-fashioned. Not cautious, not smart, just outdated. By the time people casually start using the word bubble, the real damage has already been done. And not because of fraud or secret plots, but because our own minds quietly convince us that this time is different. Where money, power, and history collide, and where things are never as simple as they seem. Here's something strange about every major bubble in history. While it's happening, it never feels crazy. It feels reasonable, sensible, even responsible. People don't think they're gambling. They think they're adapting to a new world. That's why bubbles are so hard to spot from the inside. They don't announce themselves as excess. They show up dressed as progress. And this isn't new. Long before stock apps and venture capital, people were losing their minds over assets that promised a revolutionary future. In the 1600s, tulips in Holland weren't just flowers. They were status symbols and investment vehicles. In the 1800s, railroads weren't just transportation. They were national destiny. In the 1920s, radio stocks weren't just businesses. They were the sound of tomorrow. In the 1990s, the internet wasn't just technology. It was the end of distance itself. And here's the important part. All of these things were real. Bubbles aren't built on lies. They're built on truths pushed way too far. The psychology behind this is surprisingly consistent, and it starts with something very human. We love stories. We don't understand the world through spreadsheets. We understand it through narratives. Stories explain cause and effect. They give meaning. They reduce uncertainty. And when a powerful story attaches itself to a new technology or asset, it becomes incredibly persuasive. Belief comes first. Numbers follow later. Once the story takes over, valuation stops being the starting point. It becomes an afterthought. Old metrics get dismissed as outdated. Profits aren't required now, they're coming later. Losses aren't red flags, they're investments in the future. When a story feels strong enough, math becomes annoying. Then social proof kicks in. In uncertain situations, we look sideways. If everyone else is buying, it feels safer to buy. If respected people are confident, doubt feels unnecessary. Markets make this even stronger because rising prices become proof. Every increase reinforces the belief that the story must be right. Skepticism becomes expensive. Analysts who question things get labeled pessimists. Investors who stay out feel like they're missing the party. Career risk starts to feel scarier than financial risk. It becomes easier to be wrong with everyone else than right alone. And once a consensus forms, confirmation bias takes over. People don't stop looking at data. They just stop looking at inconvenient data. Good news gets amplified. Bad news gets explained away. Models get adjusted. Words like temporary and long-term start doing a lot of heavy lifting. This is when bubbles become self-protecting. Any criticism isn't treated as a warning, but as proof the critic just doesn't get it. Then comes quiet overconfidence. Markets go up and people feel smart. Gains feel personal. Investors credit their skill, not luck. Newcomers think they found a secret. Veterans think they've mastered risk this time. Everyone believes they'll exit before the crash. Almost no one does. Luck feels exactly like intelligence, until it doesn't. Then authority steps in. Big banks release bullish reports. Governments praise innovation. Central banks stay supportive. When powerful institutions join in, doubt collapses completely. The asset stops feeling risky. It feels approved. And here's the cruel part. None of this feels reckless. It feels normal, sensible, inevitable. Prices rise, confidence grows, caution fades. Not because people stop thinking, but because thinking becomes emotionally uncomfortable. That's why bubbles are almost never recognized in real time. They don't feel insane. They feel like the world finally gets it. But consensus has a blind spot. You can't see the assumption holding everything together. By the time a bubble feels obvious, it already feels normal. That's the paradox. Modern bubbles don't need hysteria. They don't need taxi drivers giving stock tips. Today, bubbles can form quietly, driven by institutions, indexes, and massive capital flows. Which brings us to today. More investors are asking, are we seeing the early stages of an AI bubble? Not because AI is fake, it's very real, but because expectations are growing faster than the economics can justify. See, every bubble in history was built on something real. Railroads, electricity, the internet. The dot-com crash didn't happen because it didn't happen. The internet was useless. It happened because people assumed instant, perfect profits. AI follows the same pattern. The tech is real. The impact will be huge. But markets don't price long-term destiny. They price short-term expectations. And recently, a small group of AI companies has driven most of the market's gains. That concentration doesn't prove a bubble, but it's a familiar ingredient. When money funnels into a few symbols, those symbols start carrying emotional weight. Valuations rise not just because of earnings, but because of assumed dominance. Profits that don't exist yet get priced as if they're guaranteed. Huge spending is framed as strategic. Profitability is always coming later. Sound familiar? Positive headlines get celebrated. Bad news gets minimized. Skeptics get brushed off as short-term thinkers. And when big institutions pile in, belief solidifies. The question stops being, what is this worth? And becomes, what happens if I'm not in? This is late-stage belief. Not mania, not panic, just quiet agreement. And here's the uncomfortable truth. Most people aren't reckless, they're rational. They're responding to incentives. When underperformance can cost you your job, caution becomes dangerous. That's how bubbles grow without hype. They don't need excitement. They need compliance. Bubbles don't burst because everyone suddenly realizes they were wrong. That almost never happens. They burst because one assumption breaks. Growth slows, costs rise, interest rates change. Something cracks. And when it does, psychology flips fast. Confidence snaps. The same forces that pushed prices up now push them down. Social proof reverses. Bad news spreads. Institutions retreat. Liquidity dries up. What felt inevitable suddenly feels fragile. That's why bubbles look obvious in hindsight and invisible in real time. So how do you protect yourself? Not by predicting crashes. That's nearly impossible. The real goal is self-awareness. The important question isn't, is this a bubble? It's, what belief am I relying on? If growth slows, what breaks? If money tightens, what changes? If expectations reset, what survives? When investments depend on stories instead of cash flow, timelines matter. When valuations require perfection, patience becomes risky. And when everyone feels certain, that's when uncertainty deserves the most respect. History doesn't repeat because assets change. It repeats because people don't. Bubbles don't form because people are stupid. They form because belief feels safer than doubt. Right up until it isn't. The ones who survive aren't the ones who predicted the future. They're the ones who understood their own assumptions. That's the real lesson hiding behind every crash chart. If this gave you a new perspective, hit subscribe. History has the answers.